Hello learners, today we begin with one important topic. It is of interest for strategic management in the area of finance. The topic is leverage analysis. Within this topic, we will be devoting 2 classes and deal about operating leverage, financial leverage and combined leverage. Now, we know that in general, what is the function of lever in a crane? Because you have seen that a crane can lift heavy weight with little of the efforts. It means lever plays the role in a crane. In the same way, in finance, we have a word leverage. Leverage means boosting up your earning or boosting up the earning of the stakeholders with the help of little of the cost. And that little cost is the fixed cost. So whenever an organization engages certain assets or financial resources in which there is a committed cost or fixed cost, then we say the organization has used leverage. Now, point comes, which one is operating leverage, which one is financial leverage, and combination of both of these will be called as combined leverage or total leverage. So let us first proceed with operating leverage. Remind you, operating leverage refers to operating risk also, and financial leverage refers to financial risk, and combined leverage will mean total risk. When we have to define operating leverage, we must understand what is the meaning of operating cost. As we know, operating cost at this point of time means total cost of goods which we have sold out. It will comprise of cost of goods sold, that is raw material consumed, labor component, manufacturing overheads and other conversion charges. At the same time, it will comprise of administrative cost, selling and distribution cost. So we are focusing on the operating cost. Operating cost means total cost engaged in the routine activities of the organization from the scratch point where products are procured, that is raw material is procured, it is processed and sent to the sales department or showroom for sales. So that is the operating cost. It will comprise of cost of goods sold, including all the conversion costs. Then it will comprise of administrative cost, selling and distribution cost. So that sum total is called as operating cost. As we know, behavior wise, operating cost can be grouped into 2 parts, fixed cost and variable cost. Fixed cost means cost of all those activities and assets for which company has to pay committed money on a time scale basis, like monthly rent, monthly salary of the permanent staff, or it may be any other committed expense which is bound with the time scale, which has to be paid with the time scale. So this amount of fixed cost remains constant whatever may be level of activity. Whereas variable cost is the cost which is incurred only when production or sales takes place, else it is zero. It means total variable cost will have a direct and proportionate relationship with the volume produced or the quantity sold. Whereas total fixed cost will be constant irrespective of the level of capacity. That means up till the maximum production and sales capacity, total cost remains constant. And you can see behavior of cost. In the graph, you might be seeing that we have units produced. If we produce 0 units, then also I am spending total fixed cost. So blue line shows me total fixed cost. Take a simple example. If we have taken certain facilities or a plant on rent, which has a production capacity of, let us say, 14 millions. In a year, you can produce 14 million units. By chance, due to any reason, lockdown or any other region, you are not able to produce even a single unit, then also you have to pay the rent. That is called as fixed cost. And even if you produce complete maximum capacity, you utilize complete maximum capacity, then also total fixed cost remains constant. So that is the behavior of total fixed cost. Whereas variable cost, you can see with the orange line, as soon as production picks up, total variable cost will move upward. It has a direct and proportionate relationship with the level of activity, production capacity used or sales capacity used. And gray line is the sum total of that. So this is the way we can see cost behavior we have, and understanding of that cost behavior is must for the purpose of understanding leverage analysis. Now, as I defined earlier, leverage refers to the presence of fixed cost resulting from two elements, either from assets or from sources of finance. Now, apparently one indication is there. The leverage resulting from assets is the operating leverage, and leverage resulting from source of finance is the financial leverage. As a result, the earning available to the shareholders is subject to volatility. That means the moment a company has engaged certain assets on which it has to pay committed payment irrespective of the use of the asset, then earning available for the equity owners are subject to volatility. That means for every change in the sales volume, their operating income will fluctuate. So under operating leverage, we will be studying the relationship between sales and the operating profit, that is EBIT, earning before interest and tax. Operating leverage basically indicates about the operating risk of the organization. That means if a company fails to operate in the market. Now when do we say a company has failed in operating in the market? When its products are not acceptable to the customer or it is not able to sell up to the mark. Let us assume that a company thinks in the next year they will sell 10 million units and they will break even. Break even point means that level of sales at which neither we are at profit nor we are at loss. Now unfortunately company fails to sell 10 million units, then company will have the losses. Reason may be anything. So operating leverage will indicate towards operating risk. That means company is not able to operate satisfactorily in the market. High level of component of fixed cost in the operating cost. So since we are talking about operating leverage, so simply whenever in a company's total operating cost component or proportion of fixed cost is high, then we say company has high level of operating leverage and high level of operating risk. Low level of fixed cost means low level of operating leverage or low operating risk. There are three types of leverages as we have spoken earlier. Leverage associated with asset acquisition or commitment to pay fixed cost is referred to as the operating leverage. Take a simple example. There are two competing hotels. In both the hotels, guests check in and guests use the kitchen facility or pantry facility which we say. That means both the hotels are providing in-house service for the food. But Hotel A, which is having its own kitchen, they prepare the food as per the requirement of the guest, serve to the guest. Now imagine, as soon as you have your own kitchen, you will have permanent facilities. Certain investment will be in the fixed assets to cook the food. You will have chef also, staff also in the pantry or in the canteen or in the cafeteria or in the restaurant of the hotel. So that will be your committed expense. And this committed expense has to be paid every month whether guest use the facility or not. Whereas the competing hotel, which is in the vicinity of the first hotel, they are also providing the food. They are also serving the food to the customer in their cafeteria or in their restaurant or in the room service. but they don't have any kind of kitchen. What they do, as soon as customer makes an order for the food item, they simply place it to the outside vendor. Outside vendor supplies the food and the food is served to the customer. It means in this second hotel, there is no fixed cost. Fixed cost on account of restaurant is bare minimum. Bare minimum. The waiter might be there or the boy might be there who will serve the food in the room. It means you can see the difference between the first and the second hotel. First hotel, which is having their in-house facility for cooking the food, is having high level of fixed cost. Second hotel, which is not having in-house facility for the cooking of the food, they have the low amount of fixed cost. And that is what we will say first hotel, named, I will name it as A, has high operating leverage, whereas second hotel B having low operating leverage. Now think of a scenario. Few years back we had a COVID-like situation. If that situation happens and turnout of the customer or the guest in the hotel is zero for both the hotels, because they are competing hotels and they are in the nearby area also, in the vicinity also. So now if turnout of the guest is zero, Hotel A will have to pay the salary of the permanent staff devoted to the kitchen or cooking of the food. They will have to pay certain amount of expenses for the maintenance of the utensils and cooking range and all that. Whereas Hotel B need not to pay that much amount of fixed cost. So you can see the level of difference. The loss where they will have due to zero turnout of the guest. It means earning available, or here we are talking about operating leverage. So operating profit is subject to larger volatility for Hotel A as compared to Hotel B. That simply means with every increase in sales turnover, earning of the A will fluctuate at a larger proportion as compared to the earning of the Hotel B. So that particularly refers to the operating leverage. So under operating leverage, we study the relationship between sales and the operating profit, which is EBIT. The operating leverage is favorable when increase in sales volume has a positive multiplier effect on EBIT. Whereas operating leverage is unfavorable when decrease in sales has negative multiplier effect on the operating income. It is apparent too. If sales keeps on increasing day in day out, then definitely Hotel A will have more operating profit with the increased sales. Whereas if sales keeps on decreasing, they will have more operating losses. Point is simple. That particular thing relates to fixed cost. Now, you might be surprised why we are studying this. Point is that there is something called as strategic management, because having kitchen in the hotel or not having kitchen in the hotel, buying the cooking range or hiring the permanent staff, whose decision it is of the top management. They have to take a strategic decision whether we want to have the in-house kitchen or not, or we go for the outsourcing facility. So that decision has to be taken by the top management. So operating leverage as well as financial leverage are of more concern for the top management, not for the lower level management. Even at the operating level, no concern is there for the operating leverage. Middle level management might suggest to the top level management, because middle level management is like a linking pin between top management and the operating level management. So that can be done. But yes, who will use the operating leverage? Top management. Now, point is simple. Top management never involves in the calculation work. Top management needs fine points, crispy notes, crispy tips for the quick decision making. Now, in this case, this MD or CMD or board of directors or the top level managers of both the hotels, Hotel A and Hotel B, need to know their degree of operating leverage, which is, in short, I'll call it as DOL, D-O-L, degree of operating leverage. Now, degree of operating leverage refers to the change in EBIT, that is percentage change in EBIT, for every 1% change in sales from the given level of sales. And this given level of sales is the base level of sales, from where we start the calculation. from where we start the calculation. So that is given level of sales. For example, at a given level of sales, 1 lakh guests per annum, degree of operating leverage for hotel A is 1.25. For hotel A, degree of operating leverage for 1 lakh guests per annum is 1.25. This means from this 1 lakh guest per annum level, if intake of the guest, inflow of the guest or footfall of the guest increases by 1% from the 1 lakh level, with that 1% increase, EBIT will increase by 1.25%. Now imagine on one fine morning, the CMD of the company opens the newspaper that yes, from next month, Mahakumbh is starting. And that particular CMD knows that yes, we have our hotels in the same area, Prayagraj. Then definitely he is interested to know by how much my operating profit will fluctuate. So he reads the news that yes, my guest intake will increase by 50% during this festive season. Then he can quickly estimate by how much my operating profit will increase. So simple concept, operating profit, as you can see, I will explain the formula also, but if you know the degree of operating leverage, you know by how much your sales will increase. So percentage increase in sales is 50, your operating leverage is degree of operating leverage 1.25. So 50 times 1.25 gives you 62.5%, I hope. 62.5%. So that MD can quickly estimate that yes, my operating profit will rise by this much percentage from the current level of operating profit. And he can accordingly plan for the future. So this is the way operating leverage helps the top management to plan for the future. Idea is simple. If you are expecting that your sales is likely to rise in the future, you can afford high level of operating leverage. If you are thinking my sales is going to go down in near future, then yes, you have to think that I have to reduce the quantum of leverage. That means I have to reduce the committed cost or fixed cost. So that is simple indication of using this particular tool for strategic management. Now point comes, how do we calculate operating leverage? The best formula is the alternate formula. What this alternate formula says? Total sales minus total variable cost divided by EBIT. So you can see total sales minus total variable cost is also known as contribution margin. If you divide this by EBIT, for every level you can calculate degree of operating leverage. Or you can use the first formula, percentage change in EBIT upon percentage change in sales volume. Both will give the same answer. Both will give the same answer. But to remind you, for every level of sales, there is a unique DOL, degree of operating leverage. If at 1 lakh level of guest intake, if you calculate DOL 1.25, if you calculate DOL for 2 lakh number of guests, DOL will be different. So this 1.25 DOL is relevant for 1 lakh guest footfall. For 2 lakh it will be different, for 50,000 it will be different. So that is the way we calculate degree of operating leverage. So there is a handy formula, total contribution divided by EBIT gives you DOL. Now let us proceed further for practicing a numerical on that and see the difference. If you take this example, as I said, there are two forms, form A and form B. I have taken a hypothetical example. Average sales volume for both the forms is 1000 units. Now units may be meter, liter, number of customers, anything it may be. So average sales means base level of sales. Show operating leverage effect for 50% change in sales volume. When we say 50% change in sales volume, that means your 50% increase as well as 50% decrease from the base level. So we will be analyzing what will be the impact of operating leverage for both the forms, form A and form B, if sales increases by 50% from the 1000 units and sales decreases by 50% from the 1000 units. because change can be positive or negative. What are the parameters for Form A? Because what I need to do, first of all, I will be making a statement of operating profit. How we calculate operating profit under marginal costing, that we will do, and then we will calculate DOL and interpret that. Fixed operating cost of Firm A is 30,000, whereas variable cost per unit is 70. And what is the selling price? 150. Since both are the competing organizations, for Firm B, fixed operating cost is 60,000 and variable cost per unit is 40. And selling price per unit is 150, the same. Now let us see, first we will see the operating income calculation for Firm A for all the three scenario. Base case, 50% decline from the base case, 50% rise from the base case. I made a ready-made calculation, however, I will depict it, how to calculate it. So I am focusing on the base case highlighted with yellow, sales in units 1000. So you can tick it out, sales in units 1000. At what price you are selling the product? 150 per unit. So how this 1,50,000 comes? 150 multiplied by 1000. So we get it 1,50,000. So at the base level, sales is 1,50,000. Variable cost per unit is 70. For every 1 unit, variable cost is 70. So for 1000 units, it will be 70,000. So that is my variable cost. So the moment we proceed further, that means what I need to calculate? I need to calculate total contribution. And total contribution is total sales minus total variable cost. And my contribution is 80,000. So 1,50,000 minus 70,000, you get it 80,000. Now what left? We are given fixed operating cost. And fixed operating cost is 30,000 for Firm A. So 80 minus 30,000, we get it EBIT 50,000. So at the base level of sales, which is 1000 units, what is my degree of operating leverage? Simply, degree of operating leverage is total contribution divided by EBIT. The formula is there with you. Total contribution, so it is total contribution divided by EBIT. And we get it 80,000 divided by 50,000, 1.6. Now, what is the interpretation of this 1.6? This 1.6 simply means that from the base level, if your sales volume changes by 1%, for every 1% change in sales volume, your operating profit will change by 1.6%. So, for example, from this level, my sales is changing by how much? Plus 50%. So, plus 50 multiplied with 1.6, because we have to calculate that scenario also. So, plus 50 multiplied with 1.6, I get it 80%. It means, now quickly, you can, without making any calculation, without making any further calculation, you can simply say, yes, if my sales increases by 50%, my operating profit will increase by 80%. And we can verify that fact also. We can verify that fact also. 50% increase means my sales will jump to 1500 units. My sales will jump to 1500 units. Now, what will be my total sales? 1500 multiplied by 150. So, 2,25,000. For 1500 units, my variable cost is 1500 multiplied by 70. So, 1,05,000. Gap between these two, that means total sales minus total variable cost is 1,20,000. Now, remind you, fixed cost will remain the same. It was 30,000 earlier also. Now also it will remain 30,000, because we have defined it, or nature of fixed cost is also like that. It remains constant up till the maximum operating capacity. So my contribution is 120, fixed cost is 30. So I get operating profit 90,000. And now you can verify. Your earlier operating profit was 50,000. Now it is 90,000. So there is an increase of 40,000 over 50,000. So that makes it 80%. And that is what we predicted, that if sales increases by 50%, operating profit will increase by 80%. So that is what operating profit we have. Now, one more interesting fact which I depicted few minutes ago, which I explained few minutes ago. Calculate the operating leverage at case 1 when your sales is 1500 units. It will be 1,20,000 divided by 90,000. You get 1.33. This simply means that from this level, if sales changes by 1%, for every 1% change in sales from 1500 units, your operating profit will change by 1.33%. 1.33%. Right? Now, you can verify also. If you come back from 1500 to 1000, that means till previous year you were selling 1500 units. Now you start selling 1000 units only. So by how much percentage sales has declined? 33.33%. 500 units decline over 1500 makes it 33.33, because your sales is declining by how much? 500 units over 1500. We are coming back testing. We are back testing our fundamental. So 33.33% negative. So by how much our EBIT will change? So we will show it like this. Change in sales is negative 33.33% multiplied with 1.33. So we get it 33.33 multiplied with 1.33, 44.33%. 33.33 times 1.33 makes it, yes, 44.33%. That means from the operating profit level of 90,000, your profit will decline by 44.33%. And you can see 40,000 decline over 90,000 makes it again the same value. Approximation difference will be there. Approximation difference will be there. But yes, when your EBIT declines from 90 to 50, it makes it around 44,000. So that is the way we can find out how much impact operating leverage has on the operating profit. Now, since this kind of question might be there in the examination also, so we can see from the base case, if you come downside, that means your sales declines by 50%. So you can again quickly see the calculation. From 1000, your sales has become 500. What will be my total sales? 75,000 rupees. Total variable cost 35,000. So gap between 75 and 35, we get contribution 40,000. And finally, from that, if we deduct the fixed cost, we get operating profit. And at this level, my DOL is 4. This means from this level, if sales changes by 1%, my operating profit will change by 4% for every 1% change in sales from 500 units. Now you can see, we had to test the base case. You can exactly see profits have declined by 80%, because 1.6 is the DOL at the base case. So this is about firm A, which is having fixed cost 30,000. Now I hope you have understood about firm A. Let me quickly depict the same facts for firm B. So that is my firm B. Both are competitors. Selling price is the same. We are testing for the same base case as well as up case and down case. Only difference in this case is that you can see, pay the attention, that yes, sales revenue will remain the same, whatever may be the case. But your variable operating cost will be different. In this case, variable cost was 40 rupees per unit. So at the base case, I will explain first. My total fixed cost is 40,000. So contribution turns out to be 1,10,000. Difference between these two. Now what is my fixed cost? They are having a fixed cost of 60,000. Now if you make a comparison, because leverage has to be done in comparison only. In comparison to firm A, this company is having higher amount of leverage because higher fixed cost means higher leverage. 60,000 is the fixed cost, my operating profit is 50,000. And as a result, you can see my DOL is 2.2. This 2.2 signifies that for firm B, if sales changes by 1% from the base case, for every 1% change in sales, operating profit will change by 2.2%. And now, with that particular tool, you can see by how much percentage change will come in EBIT. So, percentage change in EBIT, so delta percent in EBIT is equal to percentage change in sales, obviously sales volume multiplied with DOL. So, we can see that if sales increases by 50%, so change is positive 50%, then your EBIT will change by 110%. And now, need not to go for the detailed calculation, we can quickly verify. Operating profit has increased by 55,000 over 50,000. So, 55,000 increase over 50,000 makes it 110%. On the other hand, if sales decreases by 50%, that means down case. So, what we have? Minus 50% multiplied with 2.2. That means to say change in operating profit will be negative 110%. Now, you can see you are having operating profit 50,000. It has become minus 5,000. That means our profit has declined by 55,000. Operating profit has declined by 55,000. So, 55,000 decline over 50,000 means negative 110%. So, that is the way we interpret the leverage. So, firm B is highly leveraged, high operating risk, high DOL means high operating risk. Firm A is having low operating risk, so it has got low risk. So, always DOL or operating risk is comparative. Operating risk interpretation is comparative. Now, look at the fact. When we calculate DOL at this level, have you noticed something? Our formula is contribution upon EBIT. So, what is my contribution? My contribution is 55,000, whereas my EBIT is negative 5,000. So, always remember it has to be kept as absolute value. That means ignoring the mathematical sign. So, we will keep it 5,000. Don't put negative because operating leverage can never be negative. Similarly, financial leverage can never be negative. So, don't put negative figure over there. 55,000 upon 5 we get 11. Now, what is the interpretation of this 11? If from this level sales changes by 1%, for every 1% change in sales, my operating profit will change by 11%. And you can see it was negative 5,000 and it becomes positive 50,000. Now, interpret. From 500 it becomes 1000 units. So, how much increase is there in sales? 100% increase. And as per the definition of operating leverage, if 100% increase is there in sales and DOL is 11, 100 multiplied by 11, 110. So, it will be 1100% jump in the operating profit because 100 multiplied by 11, 1100. So, we get it 1100%. From negative 5,000, we have become positive 50,000. So, that means 55,000 increase over 5,000. So, that makes it 1100% change. So, that is the way we do it. So, let me verify it. Yes. So, this is the way operating leverage is interpreted. So, dear learners, in summary, this tool is used by strategic management whether we should have fixed cost more or less. That means component or proportion of fixed cost in the total operating cost should be high or low. Now, whenever we are expecting that our sales will increase day and day night, every day, there is no outer boundary for the increase in sales. We are expecting a good sales, then yes, we can go for high operating leverage. If we are expecting some high competition, sales might be there, might not be there, always preferable is low operating leverage. But yes, obviously it is up to the top management. If they want to take more risk, they can go for high leverage. If they want to take less risk, they will go for the low leverage. Interpretation of the leverage is always comparative. So this is the way I have explained you both the cases, high operating leverage and low operating leverage. I hope you have understood that. In this class, this much is sufficient. Next class we will devote over the financial leverage. Thank you.